Hi there, Dave Keller with Sierra Alpha Research. I was originally planning to walk around New York here. I'm here in town doing some media interviews and client meetings. Going to walk around with the phone and do one of those great, walking down the sidewalk casual videos, but it's about 10 degrees out, so you get the inside of the hotel room for today's video. But I was reading a blog earlier today by Nick Majuli, who writes of dollarsandData.com, which is a pretty good blog. And he was referring to a podcast interview that Barry Ritholtz did recently with Howard Marks. And as hopefully you know, Howard Marks, I've written about him in my blog a number of times recently. I read his book, Mastering the Market Cycle, last month, and I'm pretty sure it's going to be on my regular investment readings list for sure, because it's fantastic discussion of cycles in different parts of the investing world and real estate and economic cycle and so forth. But a great sort of portrayal of how behavior and how investor psychology really drives asset prices. But what was interesting in this specific interview was they were talking about the uncertainties of investing, and so much that that there's a difference between how Nick put it, the natural world and the investment world. So we want there to be these immutable laws like we have in nature, these laws of physics, and have those sorts of things apply to investing. Andrew Lowe, who's a professor at MIT and a great friend to behavioral finance and technical analysis as well, often has spoken about the physics envy of finance, that we want there to be these rules, these laws that we can completely abide by, but it's just not the case, and that has to do for a number of things. It's the fat tails, it's the abnormal distributions, and all those sorts of things that make investing a very uncertain thing. I would say the influence or the influx of so many math, physics, science-oriented investors, hedge funds, PhD types of employing PhD types of people that are, more statistically minded, are bringing more of that mentality that there should be these laws. There are these rules. There's a model that you can build that's going to predict what's going to happen. And what you quickly learn as an investor is that, a model is a model. It's not reality. It's a model of reality. And as a result, has some imperfections. So it's funny also, having coached analysts at times in my career, I found that it was an interesting challenge, because analysts are often coached to have conviction and to state their opinion and put a lot of energy behind it, pound the table and insist that their opinion is right. But the problem with that is that's not really how the markets tend to work. You're wrong a lot, and you have to be mentally prepared for being wrong, especially people that come into the industry and not used to being wrong so often. So this leads to what behaviorists would call overconfidence, right? Where you're overconfident in your point of view and your positioning, and as a result, you start having an uneven consideration of the evidence that might be disagreeing with your position. So I think back to flying airplanes, and anytime you're in a flight plan, you're flying from point A to point B, you're flying over the skies above the New England, you're looking down always for an exit strategy. You're always looking for a place to land in the case of some emergency that is highly unlikely and hopefully will not happen, but it could. So if it does, you're always looking for that, the highway or the golf course or the abandoned airport that you can go land at. And that's just because you always need to have an exit plan in mind. As investors and as analysts, a lot of times we don't do that, right? We're so confident in our opinion or in our positioning or in our outlook that we forget to think about an exit plan. So when I'm looking at markets, anytime I make a market call or make a directional call on an asset, I always think about the exit plan. And I try to actually articulate, here's what I think is going to happen with gold, for example. But if XYZ happens, then my thesis is wrong and I'll have to revisit it. And I've always tried to get in the habit of doing that, although it's very easy to forget to do so. The other thing you can do to avoid this sort of overconfidence, avoid this physics envy in investing and accept the imperfections, the uncertainty of it, is to always think in risk reward terms, right? So anytime you're taking a position, think about the potential upside to your position and think about the potential downside as well. And don't catch yourself just thinking about the upside. Make sure you clearly define the downside. And that serves two reasons. Number one, it gives you an exit strategy. It gives you a point at which you're uncomfortable with further risk and you'd want to reverse the position. But it also primes you for the fact that you might be wrong. And even though you expect the market to go the way that you are positioned, it might go against you. And by defining that risk, you're sort of mentally priming yourself for the fact that we might get near to those levels. And then as a result, you're not making an emotional reaction to the market moving against your position. It's more of a rules-based, emotionless process, defining your upside, defining your downside, and then changing your position as the market conditions warrant it. If this sort of thinking, if this sort of discussion is of interest to you, I hope you check out my blog, marketmisbehavior.com. Again, Dave Keller with Sierra Alpha Research. Thanks so much.